For this, let's try to answer the question. Kobe Steel is a major Japanese steel manufacturer formed in 1905 that supplies global manufacturers of cars, planes, and trains. All right. The company issued a report in March 2018 apologizing for falsifying data on the strength and durability of its aluminum, copper, steel products, and iron ore powder. Following the scandal, its stock sank to 5-year low and its cost of debt jumped to record levels. An independent investigation committee investigated the misconduct and authored the report, which concluded that the misconduct resulted from a management style that overemphasized profitability amid inadequate corporate governance, the imbalanced operation of plants that resulted in reduced awareness of quality compliance among employees, insufficient quality control procedures that allowed the misconduct to take place. The report also emphasized that the company had a culture that prioritized winning purchase orders and meet delivery deadlines over ensuring quality. The company committed to implementing various measures to prevent a recurrence of the misconduct. Regarding governance, measures included the following: appointing an independent chairman of the board of directors, having at least 1/3 of the board of directors be independent, right? So again, till now we haven't seen the question yet, right? It's a case study, right? Then it is about creating and nominating a and compensation committee consisting of majority of your independent director to serve a voluntary advisory board to the board of directors, creating an independent quality supervision committee consistent of external expert, creating an audit and supervisory committee consisting of 5 members, 2 internal directors, 3 independent directors with background in legal, financial, industrial field. Now we are reaching the question, right? So we have seen a case study, we have seen how things have gone, from one stage to another. Now the question here is question number 1: identify 3 key stakeholder relationship for Kobe Steel and discuss their role in the misconduct or how they were affected. Right? See, this is again a thinking kind of case study. It's not like an exam kind of case study because an exam they will not ask you to discuss. It's a multiple choice question exam, right? But let me explain, right? See, what went wrong here, right? Data falsification on your product quality. Product quality was compromised. Management prioritized your profits. Management prioritized your deadlines. There was a weak board oversight, poor quality controls, poor systems, right? Then question 1 asks key stakeholder relationships, right? For Kobe Steel and discuss their role in the conduct or how they were affected. See, one key relationship is between company and customers. The relationship is generally contractual in nature. Impact was that due to the inferior quality product, there was a risk to the public safety. So that was a big concern. Second relationship is between board of directors and company. Relationship is more like agent relationship. The impact here is that failure to monitor your management led to your reputational and legal damage, which is severe. Then there is a third relationship, which is between your managers and employees. Relationship is again contractual in nature, but impact is that this kind of culture encourage delivery over quality, right? So that we need to understand. Then we go to your question number 2. Question number 2 is about discuss the stakeholder incentive and the conflicts that arose between Kobe's management and the company's customer. So when you look at the incentive conflict between your management customer, basically the idea here is that management or the customer, in fact, wanted safe, high quality materials. Management wanted orders, management wanted profits, management wanted deadlines. Quality standard should align your incentive, but profit pressure kind of dominated, so which is not right. And third is your question number 3, which is best governance measure, right? When you look at it, which of the following is considered a best practice that will strengthen the measure discussed to prevent a recurrence of the misconduct? There are 3 things given: a shareholder rights plan, a stock-based compensation plan, and audit committee composed solely of independent board members, right? See, the idea here is, if you look at the option A, right, shareholder rights plan, please keep in mind that a shareholder right plan protects you against your hostile takeover, does not prevent your internal misconduct, right? Then look at option B, right? Now you look at option B. So option B is again wrong because when you talk about stock-based compensation, please keep in mind that it aligns your incentive with the shareholder, but may increase your risk taking, which was already the problem. And the audit committee, right? That sounds correct. Audit committee composed solely of independent director because independent directors or independence of the committee improves your oversight, reduce your management influence, strengthen your monitoring and accountability, right? So keep that in mind. So that is what is the correct answer here, right? So think in a proper sequence, understand the relationship. Once you do that, I don't think there should be any issue, right? This is what I mentioned. Everything we discussed while talking, the relationship was contractual, agent, contractual, right? Role or impact, right? I mentioned when we were discussing, so I'm not repeating again. Then question number two and question number three also I mentioned very correctly. So I hope you would got a sense, right? You will get a time to read this, so spend some time reading this, but I have already explained you what exactly happens, right? So with this, let's move ahead. With this, now we go to the question, discuss the financial risk implication of the post-scandal stock and bond process with regard to investor confidence, right? So again, this is a case study which has been taken from the book, right? So let me explain what it is, right? We will not, again, this is discussed, right? It's not coming in exam, right? That way. What happened here about the stock price fell, the cost of debt rose. So the idea here is that if you look at the equity market signal, investor lost with confidence, expected future cash flows fell, risk premium kind of increase. If you look at the debt market signal, higher perceived default risk, credit spreads kind of widened, cost of borrowing increased. Why confidence matters more than governance alone? Because if governance improves, past profits may have been overstated, your customers may not return, and future sales and margins are kind of uncertain. So governance kind of fixes your trust, but earnings kind of fixes your price. So if you like just focusing on what exactly in this chapter you're doing, right? Please keep in mind that we are reading about conflicts, right? Conflicts arise due to your different incentives. Your governance is basically about managing those incentives. Markets punish your loss of trust faster than your poor earnings. So it's very important that you maintain or keep away from anything which kind of erodes. Then we have a practice question, guys. Kobe Steel's governance failure most likely resulted in reduced growth opportunities. Cost of debt would have increased, agency cost would have increased, growth opportunities would have decreased, right? So, why? Because reputation got damaged, right? So, reputation damage is a big problem. Customer lost trust, new contracts declined, future sales would have become uncertain, growth would have slowed if operations continue. Why not cost of debt? Because generally, in such cases, bond yields increase, higher perceived default rates, cost of debt rise, not fall. And when why not agency cost? Because company increased your monitoring, hired independent investigator, added your independent directors. So that is it, right? So keep that in mind. That is what I have explained you here. Okay. Now let's do the practice question, right? See, issuer changing its credit term for a customer from 210 net 30 to 210 net 40, right? Will most likely experience what? See, when you are going from 210 net 30 to 210 net 40, right? Basically, what are you doing? The customer is getting, earlier he has to pay in 30 days, right? The whole amount. Now he's getting 10 more days to pay, right? So customer is obviously happy, right? Account receivable will increase because all customer will delay payment. Your days of your account receivable will go up. That will push your days of sales outstanding up. The cash conversion cycle will go up, right? So that's what we'll have. Now, if this is happening, the question is asking about liquidity. See, if cash conversion cycle is going up, time to collect cash is going up, liquidity is going down, right? It is a drag on your liquidity, right? So remember that. Okay. So if you want me to put it some exam related fundas, so basically any action that increases DOH, increases DSO, decreases DPO, hurts liquidity. right? So this is DPO is different. The rest all are same, right? Decreases DPO is different. Rest all are same. Increases, right? So your opposite movements, if it is opposite movements, remember it improve liquidity, right? So remember, like this will be asked in exam if you put it right. Overall, what we have understood here, till now, what we have done is we are trying to understand your cash conversion cycle. We are clearly identifying that conversion cycle is not just about remembering the formula that DOH plus DSO minus TPO. You have to understand that the timing is very important. The right when you look at the cash flow, and financing is also very important, right? So that's what we have to do. Okay. Then okay, this is I have explained you. Next question: which of the following will most likely decrease an issuer's cash conversion cycle, right? So again, triple C is equal to DOH plus DSO minus DPO. Na? So if your, what do you say, talk about A, option A, right? If your increase in your uh, sales outstanding, right? So if your sales outstanding is increasing, right? Increase. So basically DSO is increasing, right? So DSO is increasing. DSO increasing, you're asking for decrease, right? So DSO increasing will not serve the purpose, right? That's what we have. Then increase of inventory on hand. This also increase. This will not serve purpose, right? Increase in payable outstanding. Obviously, this negative sign is there, so this will serve the purpose, right? Simple. So this is done. Okay, yeah. Practice question 3. Right. So this is a balance sheet given, right? You see cash, marketable security, accountable inventory, all these things are given for issuer A, issuer B, issuer C. Which issuer is most liquid based on the quick ratio, right? So quick ratio, if you don't know, quick ratio is you have to remember this formula: your cash plus your marketable security. I'm writing MS plus account receivable AR divided by your current liabilities, right? So again, in this, when you are trying to find out, inventory is excluded, right? So you will exclude inventory, right? Prepaid expenses are excluded, right? Because this doesn't come. Only short-term obligations, right? Go in the denominator, right? So this is only short-term obligation. Current liabilities are account payable and account expenses that we take, right? So very simple kind of thing. In If you take for asset issuer A, right, it is cash is 100 plus your marketable security 20 plus your account receivable 300 divided by your uh, what? Divided by your 400 plus 40, 440, right? So it is 420 by 440, right? You can find others also, and that's your homework. You can take practice this question, but I've done for this one. Again, I think 120 if I have to do also, right? B is 120 plus 10 plus 300, right? Divided by 520. C is 50 plus 20 plus 200 divided by 300, right? So it's not difficult, right? So uh, this is 430 by your 520, right? This is 50 plus 20, 70, 70 to 70 by 300, right? So you calculate all these ratio, issuer A comes the highest one, right? So you can solve. I don't think there should be any difficulty here. Well, this is all done. So that okay. Then we have a question here, right? Your an analyst is evaluating the what you say evaluating an issue's liquidity and calculates a negative cash conversion cycle. Negative cash conversion cycle is there, right? So it is how do you get a negative cash conversion cycle? In fact, there is a very famous reel where I think some big person is talking about Richard Branson, that how Richard Branson started his airlines. What is his airline? Virgin Atlantic, right? How Richard Branson started his airlines, Virgin Atlantic, right? By negative cash conversion cycle, right? This is a very famous reel. If you just put in your mobile, right? Richard Branson, Virgin Atlantic, negative uh, cash conversion cycle, right? Very interesting reel, right? So that's what you have, right? So for the issuer in the most recent, this result says not feasible. No, this is feasible. I told you, Richard Branson example is there, right? That is absolutely feasible. This is what people get surprised, right? So it is possible because the issuer has sufficient cash and marketable securities on hand to support the short-term need. Possible because the investment in inventory is returned quickly and the issuer take advantage of vendor financing. Same thing Richard Branson has done, right? Just watch this reel, right? Watch this reel, right? There is a reel, right? Podcast type, right? Where somebody is talking about how Richard Branson started it. Okay, you can find it also, like if we just Google it, right? Let's Google it. Um, Richard Branson negative CCC airline. Yeah, this reel 3.12, right? This reel podium VC, this reel, I think I'm talking about the first one, right? Again, there are a lot of reels here, but you can go, they talk about the same thing, right? And the answer is the C, answer C, right? So you can go and watch it. Very interesting and practical use case. All right. Then, then we have a practice question. The practice question here is that uh, an issuer eliminated the prompt payment discount it had offered to customer. This action most likely will do what? See, if you kind of eliminate, right? Basically, we're talking about what happens to the liquidity, right? See, if you eliminate your prompt payment, right? It will actually decrease the issuer's liquidity, right? Why it will decrease the issuer's liquidity? Because see, uh, if you are eliminating, right, the prompt payment discount, right, then what will happen? Customers uh, customers have no reason to pay early. They will say that, oh, why should I pay early? I have no discount. Nah? So they have no reason to pay early, right? So basically, later payments, if you have later payments, right, it leads to higher DSO. Higher DSO means obviously higher your cash conversion cycle. Higher cash conversion cycle means drag on liquidity, right? Drag on liquidity, right? So basically, you're decreasing the issue liquidity you have. Okay, very simple, right? Very, very simple. Okay, yeah, that's it, guys. So hardly like what 30 to 50 minutes, not 50, like 45 minutes, 25 plus 20, 45 minutes chapter, easy chapter, not difficult. I don't think there's anything in this chapter which is difficult. We go back, quickly revise. Okay, then we have the questions now, which are very tricky questions now we have to do. Okay, so in these questions, let's try to do it. Uh, Larissa Soroka, an analyst at ABC Company, has been asked to prepare cash flow forecasts for two mutually exclusive investment projects related to new products. ABC's management asked Soroka to include the cost of market research that was recently completed as well as the potential loss of revenue from existing products. And that could occur if other project is undertaken. Soroka presents the forecast in Exhibit 1. and is asked to calculate the IRR and NPV for both projects. Investors in ABC have a required rate of return of 8%, right? So that's fine, right? Then this project A, you can see the cash flow of different years. Then ABC management asked Soroka to consider and forecast the impact of 6-month delay in all future cash flows and estimate the impact of that event on IRR and NPV, right? So there is delay, which is used forecasting. After reviewing the forecast, ABC management asked Soroka to estimate ABC's ROIC for 2022. ABC earned operating profit of 8830 and an effective tax rate of 22% and reported the balance sheet in Exhibit 2. Right? Again, right, such kind of question doesn't come, such long question. This is more for understanding, right? Like small questions come, right? Practice question 1 to 5 are given here. So this is the balance sheet given, your liability and equity is given, right? So quite a long question. You have to sit down with it and think about it, right? Now we let's try to solve the question, right? So ABC management has an ROIC objective of at least 9.2, at least 9.2, and asked Soroka for her recommendation about the projects. Question 1 is, when preparing the cash flow forecast for both projects, Soroka should include what? See, let's try to recap the case, right? So basically, there are two mutually exclusive projects, your project A and B. Required rate of return, hurdle rate given in the project is what? Required rate of return, if we read carefully, it is given as 8%. Hurdle rate is, required rate of return is 8% they want, right? So this is given here, right? Here you can see, right? So required rate of return is already given as 8%, which we need, right? You have to sit with this question, guys, spend some time, right? Now that has been given, you are like, okay, fine. Then ROIC target is given greater than 9.2%. So market research already done. Possible loss of revenue from product is already thought of, cannibalization, right? That's okay. So this setup tells you, right, that you have tested on your incremental cash flow, you have looked at the sunk cost, you have looked at the NPV, IRR, you have looked at the timing ROIC. Now, the question comes is, what should be, or when preparing the cash flow forecast for both projects, Soroka should include in your on the calculation, right? So the key idea here is that if you look at the cost of the market research, right? Cost of the market research is already a sunk cost, right? Already completed before, cannot be exchanged, so sunk cost, right? So you should not include that, right? Sunk costs are not included, right? Then you look at the loss of revenue from existing product, right? Again, if you look at loss of revenue from existing products, right? Okay, it happens only if the project is undertaken, changes your future cash flow, incremental negative cash flow include, you know, all those things, right? So, okay, fine, this can be included, right? Loss of revenue from existing product, like Diet Coke versus Coke, we can include, right? Then both the market research and loss of revenue from existing, no, market research is not, huh? You should not include, right? So it's an easy thing. It's, you don't need to, just remember the Diet Coke versus Coke example which was given, right? So loss of revenue from existing product is should be considered, right? Moving on, next question. Our basic idea here is the past is quite irrelevant. Don't bother about a decision dependent on the cash flow now, right? With regard to project A and project B, which of the following is true? Both projects should be invested according to IRR decision rule. No, we don't take the IRR decision rule, na. I told you very clearly IRR decision rule, right? Both projects should be invested according to NPV decision rule. This can be the answer. We're just keeping it. Only project B should be invested in accordance to the IRR decision rule. Now, B and C we have to see, right? What is so special about C, right? Why we are saying that C is sorry, not C, but only project B should be investing according to IRR rule. Why are we going there, right? See, when we look at the project A, right? Project A fails the your IRR rule, right? So basically, if you look at Exhibit 1, right? So project A is kind of, if you see, Sroka present the forecast in Exhibit 1 and is asked to calculate IRR for both projects. What is she presenting? Is it cash flow, na? Where is the IRR she has presented? Hmm, where has she presented IRR? Where has she? Uh, tax rate 22, right? What is going wrong here? Where has she presented IRR? Um, is asked to calculate IRR and NPV both. Investing in ABC have a required return of 8%. Required return is given. I need to find the IRR here. This is balance sheet given. Liability return, retained earnings. Something missing? No. What is the answer? Just let me check something I have missed out. Okay, basically, what have they done is uh, question one we had done. Question two is the IRR decision to invest with the IRR exceed the rate of return hurdle rate, right? Okay, they are calculating IRR, right? So they are calculating IRR in both cases. Okay, fine. So basically, okay, fine. They're not given directly. I was thinking they are given directly, but basically you calculate, right? The idea here is you calculate your NPV and IRR because cash flows was given, na? So cash flow given, calculate NPV and IRR. Okay, so that is what is the thing. And then when you calculate, you see the project B's IRR is 8.97, which exceeds the required rate of return of 8%, so that's fine. Project A's IRR is 7.04, which is below the required rate of 8%, right? So again, A, A, the NPV was negative, so you can't invest, right? NPV is negative, you can't invest, right? A's 7.04 is also coming later, you can't invest, right? Right. So A, you cannot invest. B, NPV is coming positive. IRR is also positive, right? So in both cases, B can be invested, not A, right? So again, the calculation has to be done, guys. Practice, go back and practice in your spare time. But that's the whole idea that both projects cannot be invested because NPV is coming negative, right? So answer is C. Okay. Question number three, the most likely impact from the cash flow timing considered by Soroka is that, see, whenever we consider the cash flow timing, it affects your NPV definitely. We know that, right? So NPV stay unchanged, no. NPV would increase, no, right? So cash flow timing was, what was the cash flow timing considered? Cash flow lower PV was taken, na? So delay in all future cash flow. If cash flow is delayed, the NPV will go down, right? So lower cash flow, right? If you have lower cash flow, if you have lower cash flow, right? You have lower NPV, right? So that is what NPV will never increase, right? Now, what about IRR, right? We have not NPV would decrease. So this looks like a right answer. That's okay. But idea which I want to tell you is that if there is a lower cash flow, right, your effective return also gets down, right? So IRR also goes down. Lower cash flow, right? So if the cash arrives later, your present value falls, your IRR also falls, right? So lower cash flow, IRR also goes down, NPV also goes down. So both goes down, right? Again, you have to do this question, guys. These are the essence of the chapter, right? Okay, then we have question number 4 and 5. Based on ABC's balance sheet presented in Exhibit 2, Soroka should calculate what? Again, if the balance sheet is given, right? So, average invested capital ROIC, you have to do the calculation, right? You have the formula NOPAT, right? ROIC, you have to take the NOPAT, and then you have to take your average invested capital, right? Which is you have to subtract the working capital, you have to take the long-term debt, right? You have to take the equity, right? So I'm not doing it. This is your homework, but solution is given to you, right? Just go and see it. Same thing has been done here, right? See, uh, average debt, long-term debt plus equity, right? For 2 years, 2021, 2022, they've added taken two. So they have taken the mean value, right? And then this is 72,510, right? And then it has been calculated, right? Just note down the calculation. That's okay. This is your homework. Okay, just do it. You have to pick up your pen and paper and you have to use your calculator to solve it. Then question number 5, which is considering ABC's management's ROIC based investment criteria and the IRR and NPV of both projects, Soroka should recommend what, right? See, again, the point here is that once the ROIC based investment, okay, when the ROIC has been calculated, IRR has been calculated, right? Now, just to put a perspective, once you do all the calculation, the IRR for A project will come out as 7.04. B project will come out 8.97 in percentage. NPV will come down as your minus 0.38. It will come out as 1.12. Your ROIC will come out lower and lower, right? So when you do the project comparison, right, uh, on the ROIC in the ABC management thing, right? So the idea here is that uh, considering ABC management ROIC based investment criteria and the IRR and NP of both projects, Soroka should recommend what? See, if you are uh, looking at everything, right? See, idea here is that if something is getting lower, you reject that, right? Basically, first funda is that this is actually a very tricky question, right? To be understand, right? So see, the minimum ROIC in the question it is given given the minimum ROIC the company wants is 9.2%. It is given in the question. The minimum ROC required is 9.2, right? You are not meeting it, so that's not important. Now, obviously, IRR is also less. If 7.04 is less, right? So we, kind of not take it, right? And even if you think of 8.97, right? Right, IRR is also, if you consider IRR, that is also lesser than your ROIC, right? So accepting, I told you very clearly when we were, making notes, right? Initially, here you see, this is one of the very tricky question, right? In this case, what is happening is IRR is 8.97, right? It is less than your ROIC target, right? Which is 9.2, right? So even if you accept project B, right? It would reduce your overall ROIC, right? Which management does not allow because management want ROIC to be 9.2, right? So the idea here is that if you look at A and B both projects, right? So both should be actually rejected, right? Because there is no way to accept A project. B project also, this is bad, this is bad. Even the net present value is positive, but net present value is not the question, right? It's not about project. They are saying that they want to maintain minimum ROIC 9.2. Even if you accept the project 8.97, which is project is adding value, but project is not adding value, which the management wants, right? Management wants a very high, good project, right? So we reject both projects, invest only in project B, right? This is the option which confused a lot of people that they will say that, okay, sir, invest only in project B because there's a positive NPV. But positive NPV is not enough, right? Because 8.97 return, management wants 9.2% return. 8.97 is less than what they want, 9.2, right? So that's what. Invest only in project A because has positive cash flow during all 4 years. No, cash flow doesn't matter, right? Ultimately, we are looking for value creation, right? So whole idea, in fact, very critical idea here is that a firm can reject a positive NP. Like I'll write down very clearly. Uh, this fifth question is very tricky. So a firm can reject, right, a positive NPV project. Okay, if constrained by ROC targets, right? So even though they are good, 8.97 is good, but it's not that good which you want, right? So this is very tricky question, guys. Go and read the answer also, try to solve this also, make a note of it also, because if you don't remember this special rule, right, you'll never be able to answer in exam, right? So ABC management, this is what the question says. ABC management aims to achieve a minimum ROC of above 9.2, but IRR of both projects fails to meet this minimum criteria. Even though project B has a positive NPV, if it were undertaken, it will reduce ROIC. B is incorrect because even though project B's NPV is 1.12 million, ABC is well, IRR is 8.97, which is below the target of 9.2. So it would lower ABC's ROCs. Again, ABC is incorrect because IRR below ABC's management ROAC, right? So very tricky question, question number 5, right? So difficult topic. This is the first difficult topic. In fact, next 6 and 7 chapter is also quite difficult from the corporate issues. Otherwise, first 4 chapter of corporate issues are like a cakewalk, right? Very simple, right? But keep in mind, you have to, whatever the questions were given, question 1 was about your understanding of incremental versus sunk cost. You never consider sunk cost, what is gone, what is gone. Then you have to IRR decision rule. You have to be very clear about that. Then cash flow timing always hurts value, whether it is IRR or NPV. ROIC uses NOPAT formula. You should know average invested capital. You should know that working capital will be subtracted, and ROIC constraints can override even NPV, right? So this is the last concept. ROIC constraints, right, can override NPV as well, right? So keep that in mind. Okay. So that's it, guys. That's it in this chapter. But this is the first tricky chapter of your corporate issuer. Okay. If you have any doubt, you can ask me. Otherwise, we can stop for the day. You can go back and revise. This will have a lot of questions. In fact, all CFA questions we have covered, but you can go and do questions from Shwetha, on analyst prep, on your what you say, uh, your test series, etc. From so that you can try. Okay. All right.
So
Any
I'll
doubts?
have to go more in depth to be able to come up with the doubts. So
Okay.
I'll try to be, ready for tomorrow's lesson. What are we going to do tomorrow?
Tomorrow we are continuing with the next one. The next one